Okay, awesome. Thank you so much for folks coming to this session. This is part of the Senior Living Monthly that we do. So this is our fourth session. I'm happy to have Roberto come here and do an underwriting. There's been a lot of interest in senior living and underwriting because it's a new asset, and this asset is very different from multifamily. So underwriting it properly matters a lot. So Roberto is like an experienced real estate veteran and a well-known warrior here. He's the founder of like Blue Shores Capital, and happy to have him do the underwriting for us. So Roberto, the floor is yours. Please take it away.
Awesome. Thanks, Tilak. All right, I see familiar faces. Welcome, everyone. For those of you who I don't know, thanks for joining. Underwriting is a confusing topic to condense in under an hour. So I'm going to present it to you in a slide deck formation, and then actually do a live underwriting for you using the tools that I use. It might drag on to that 45-minute mark for my presentation, but hang tight. I'm going to open the floor at the end for some questions. PowerPoints. Okay, I'm going to share my screen. Right, everyone good?
We see it?
Yeah.
Yeah, awesome. All right, underwriting senior living facilities like a pro. So I'm going to try to guide you guys from the P&L to the projections. Confidentiality disclaimer. You guys all know I'm not a lawyer, I'm not an attorney, I'm not a financial advisor. This is for educational purposes only. You have to consult those professionals that I mentioned above. If you want to invest, I'm here just for education, knowledge, and to share my experience with you guys. So quick highlight of who I am. I was born and raised in Toronto, Canada. 2 years ago, recently moved down to Fort Lauderdale, Florida. Now living happily with my family, my wife and 2 kids. I started my career in the banking sector. Worked my way up to a financial advisor in the banking sector after a short 6-year stint. Didn't like the banking world, so I transitioned to follow in my father's footsteps. He was a general contractor, so I worked with him for about 8 years. That's where I learned how to deal with high net worth individuals and deal with people in general, trade, suppliers, homeowners, all that stuff, how the language is spoken. After an 8-year stint with him, he was getting old. I had to pivot, and I had my own vision and my own dreams. I wanted to grow it to a larger company, scale it. So I went on my own for the past 14 years. I've been on my own, owning and operating a general contracting business in the Toronto area. I stopped that as soon as I moved down to Fort Lauderdale about 2 years ago. Bigger opportunities down here. I have 500 units in the last 2 years, $25 million assets under management. I'm set to close another $25 million assets in the next 3-4 months, and I have over 250 units currently under contract as we speak. What I'm going to try to convey to you guys today, what you'll learn today, is what makes senior living different from the other commercial real estate classes. Why is it different from multifamily? Why is it different from RV parks? The revenue, expenses, all the drivers that produce the returns that we see in the assisted living and memory care space. How I look at rent rolls, T12s, and the P&Ls. It's a different way of looking at it from your multifamily space to your senior living asset. I'm going to actually do an underwriting model for you live. Then we're going to talk about some mistakes to avoid when we project our returns. And my approach in validating if it's a good deal or a bad deal. Everyone has a different validation method and different metrics. I'm going to show you the metrics that I use and that I like.
Roberto, one thing, can you zoom in the presentation because it only covers half the screen?
I can. On my screen, it shows full. So if you show me how to zoom, I can zoom in.
Oh, very weird. Because for us, it shows, it comes in the middle. So not what.
So Roberto, you see 100% on the top. Just change it to 120. Just type it in manually.
Give me a second. I don't see anything at the top. Hold on. I'm in presenter view, like a full.
Okay.
Actually, there's
that's
something on the bottom here. Hold on.
You can actually zoom yourself. There's like a plus button
But
there. You can zoom
I don't
yourself.
see this plus. I have a little tab on the bottom left.
In the middle, in the top.
Yeah, I think he's not seeing that. So what
Yeah.
Matt is saying is like in the Google Meet, there is a zoom option at the top. Like viewers can actually zoom in on their own.
Oh,
No, you can't.
Oh,
I
I got
tried
it
it.
at the bottom.
Hi, this is Ronnie. I use my cell phone. I can use my finger to enlarge the screen to change, make it larger, easier.
Hey, Scott, you raised your hand. You want to add anything?
Is this
No,
getting better?
I'm just trying to find the screen again.
Okay.
Is this better? I found the little zoom in, zoom out button.
It's not changing, but let's continue. I think people
yeah,
can
let's move on. Yeah.
record. One quick PSA, like except Roberto, everyone can please go on mute because that way it's cleaner. Thank you.
Thanks.
Okay, Roberto, go ahead. Continue, please.
Okay, no problem. So a high level overview of what senior living is. Most of you might know what senior living is, most of you not. Basically, it's a place where seniors, either 55 plus or 65 plus senior demographic, go to live out their last remaining years, either because of care needs, for disabilities, or for even sense of belonging and a community aspect. We'll talk about independent living. That's more of a community aspect type of setting. So it's not always medicinal reasons. It could be just a sense of belonging, a sense of community. But they do have 24 hours, 7 days a week assistance that help you with your meals, nutrition, and activities. So there's a bunch of different types of senior living: independent living, assisted living, and memory care. Those are the three that I'm going to focus on today. There are another three that people do talk about: residential care homes, skilled nursing facilities, and CCRCs. Those are different way of underwriting, different business plan, different model altogether. I focus on the left side of the page: independent living, assisted living, and memory care. I'm not going to dive deep into this because I want to get into the weeds of the actual underwriting. But any questions that you have of essentially either of these types of senior living facilities, you guys can ask me at the end. I wanted to show this chart because I think it's one of the most important charts for beginners like us to look at. You have high cost on the left and a level of care spectrum on the bottom.
Hey, Roberto, excuse me, the chart is not showing. We're just seeing the pro forma with the building.
Well, you guys are, it's a whole different screen then.
Yeah, we are
Yeah.
the Savannah Court of Milledgeville. That's what we are seeing.
Okay, then it's all different now. Okay. So you didn't see any of my presentation, the slide decks?
Okay.
Right now, no, Roberto.
No, Roberto, we have not. I think that's the reason that Zoom problem was happening.
All right, give me a second. Is this what you see?
Yeah,
Now
now
we
it's
see it.
It's good.
Yeah.
Okay, you want me to start from the beginning or just keep going?
keep going. I think
That's
we
fine.
can catch up. It's okay.
Keep going, Roberto. Thank you.
Okay, perfect. Okay, so the spectrum here, the chart here shows the level of cost on the left and then the level of care on the bottom. So the lowest cost and the lowest level of care is adult daycare, and then it transitions to the highest cost, highest level of care, which is kind of hospice and dementia type of care. I like to focus in the center of the chart with the assisted living, the dementia. Some of my residence facilities I own are hospice care. That's where I like to concentrate my expertise in. How senior living facilities make money. So they charge a base rent for each resident. So for example, let's use $3,000 as a base rent for assisted living residents. So upon entry, they do a analysis, and they can go up from 3 different levels on top of base rent. So base rent $3,000. If they need a little bit higher care level, then they can charge an extra $200, for example. Maybe they need an additional care level 3, they can charge $300 on top of the base rent. The same thing goes for memory care. That personal care, care service fees are considered additional or other income. Base rent is where you formulate your average rents, because that other fees, that care level, can change from different levels depending on the resident's need. The expenses is where it gets tricky and different from multifamily. So about 50% of our expenses in senior living come from labor, nurses, caregivers, admins, all that stuff. Your operating expense to run the facility, because it's not your traditional multifamily asset, you have food involved. So now you have to add a food line item, supplies, your marketing, your insurance is sky high on these facilities, and then your standard maintenance, management fees, and admin overhead. Okay, these are 6 items that I have to have before I begin my underwriting. I do a market study, whether I do it myself or pay a firm. I need a market study to know how that market's going to benefit me, if it's a good market or a bad market, and what's the population consensus in a certain radius. The OM, T12, P&Ls, and rent rolls I need upfront to analyze my underwriting. And then an important aspect to ask a broker is ask them for the occupancy census. This could paint a picture potentially. If you look at the last 12 months occupancy consensus, if it's in a downward trend, that might raise concerns. Why are they not attracting residents like they were 5, 6, 7 months ago? Maybe they decreased their marketing budget. Maybe they decreased their staffing. Why is that trend going downwards? If it's going upwards, it might not necessarily be a good thing. They might be filling it up with non-qualified residents or Medicaid paying residents, which means Medicaid paying residents are paying a lower price than your base rent. Medicaid is capped at a certain amount per state. So you have to understand the occupancy census to know what you're getting yourself into and how to underwrite it accordingly. Okay, so now I'm going to talk to you about the actual underwriting. I'm going to show you how to underwrite this. So this is my rent roll that I get from the broker. Actually, let me start with, where did it go? So, okay, now that OM disappeared. Okay, this is the rent roll that I get from the broker. I hid the names on the left, but the main concern that we look at is rent amounts, highlighted in green, personal care, so that's the additional levels of care that I spoke about before, and then your total rent. What we use in underwriting is monthly rent for our rent projections, and then personal care goes under additional income line item. So from this rent roll, the average rent that I get for this facility is $34.86. There's a total of 33 current residents staying at this facility. This is an actual T12 statement. You have the tabs here, the P&L for 2024, and then the January, February of 2025. I annualized all this. You'll see the AL and MC care levels, and then all your other income revenue. The expenses consist of operating expenses, administrative expenses, marketing expenses, resident care, resident programs, which is activities, and then you get your food, and then other maintenance and issues like that, housekeeping. Okay, let's get into the underwriting. So I use the MFA tool. I'm comfortable with it. You guys can use any tool you want, but I'll show you how I formulated this spreadsheet to help me kind of plan out at least my first year pro forma and what targets I have to hit. So I know this facility is built in '87. It's located in Georgia. Right now they're struggling. They have 69% occupancy. Their asking price is $2.7 2. I know from my market research that this market cap rate is about a 9.5, 9.7. I like to underwrite conservative, so I start at a 10% cap rate to be on the conservative side to kind of weed out any doubt that I have. If my returns and metrics are close enough at the end, then I can decide to play with that cap rate to bring it down to a 9.75. What I'm seeing from my experience from my other facilities, LTVs in senior living can range from 65 to 75. So I start my underwriting at a 70% LTV. It's extremely hard to get lending on senior living facilities, especially if you're not experienced and it's your kind of first or second time go around. Lenders will have a tough time approving you. So typically we think of a scenario that we're going to start with a bridge and a transition to a HUD. So it takes about an 18 to 24 month period. So if I'm assuming I'm going to get a bridge loan at the start, or a community bank is going to offer me a term but at a high rate, on the conservative side, I'll start my underwriting at an 8.5% loan. Just here, my partner splits, I always start at a 50-50 GP LP split in the senior living space. When I underwrite multifamily, I'll do the 80-20 in favor of the LPs, but I know the returns, I know the metrics, I know my price per units that I'm looking at, so I'll start with this basis, and then depending on my metrics that I want to hit, I can change them either up or down. My very first facility that we closed as a team, it was a 20-80 split in favor of the GPs. So the GPs are getting 80% of the return, and we're still hitting a 3.2, 3.3x multiple on a 5-year hold. So the returns here are great if you're underwriting it correctly. Okay, so I'm going to play around with this unit mix with you. Actually, yeah, let me play around with the unit mix for you guys. So I know this facility has 48 beds, not units, beds. The average rent is $34.68. Based on my current market study, I can comfortably get $3,800. So I'll insert that. Here's where you got to pay attention. So units to renovate, the facility is 48 beds, but it's 40 units. So I'm not renovating each bed, I'm renovating each unit. So we have to make sure that in this column we have the actual units, and on the other 48 number column here, we have the actual bed count. It's going to cost me about $2,000 to upgrade the units. Basically what we do in a senior living space is change out the floors. If there's old carpeting, we put that vinyl laminate flooring and then give it a fresh coat of paint. Typically, from what I'm seeing, the bathrooms don't need any major upgrades, maybe a new faucet, a new sink, but nothing out of the ordinary. These are not A-class facilities. These are your B, B-, maybe C+ facilities. The seniors don't care about that bright, shiny Carrera marble. So my rent premium after I do my little upgrades, renovations is about $250. So you'll see here, I'm confident on my market research that for assisted living, I can hit that $4,000 per month target after year one or around the 18-month mark. I know my competition is hitting $3,900 to $4,100, so that's where I'm going to target is a $4,000 average rent after year one. Down here is where I put my current number of residents. So 33 residents right now that are paying. So I'll show you how I tweaked this underwriting model to show it come on a month-to-month basis. So I created this formula, this chart here. In the top yellow section, these 3 columns in the yellow section, see number of rent increases, number of new units, number of new residents, and new rent amounts. So rent increases means when I take ownership on month 1, because the existing residents are below market rent, I'm able to come in, send them a notice of rent increase, and then charge the projected rent that I'm trying to hit, or the market rent. In this case, it's $4,000. That process takes 2 to 3 months. So I'm not going to hit them on month 1 on new ownership. I'm start sending out those letters on month 2. So now on my line item, I'm expected or anticipating to get 10 residents that are existing to get bumped up to that $4,000 current market rent. month 6, 13 residents, and then month 7, 10 residents. So that's 33 existing residents that will agree to that $4,000 bump. This is where you have to plan out your business plan. How many new residents can you potentially get? How are you going to get them? And what makes you think you're going to hit that number? And how does it affect the bottom line items? So I'm projecting in this underwriting model, I'm going to get 6 new residents in the first 12 months. I'm going to bump up my expenses on the marketing side and staffing to make it a comfortable facility to bring their family at, and then the outsourced marketing to attract more potential residents. So every time I play with these numbers, the formula changes. So maybe this month I project my operator is going to do a really good job. He's going to bring in 5 residents by month 5. He's proven to me that he can do that. So I change it to 5 residents, and it changes the whole spreadsheet. So this is very important, especially on your first year of ownership, to see what metrics you're hitting, what numbers fall into what place. So I did the same thing with expenses. So these are my expense line items. You have payroll, food, G&A, advertising, so on and so on. Here in this column, I highlighted it. Based on my research, based on these market studies that I've seen that are paid for and that are given back to me, that number amount you see in that column I highlighted. So for payroll, it's $40 per resident per day should be your underwriting gauge and number that you're trying to be in that range. Same with food. Food costs $14 per resident per day. So it's not per licensed bed, it's per resident you have. So month 1, I only have 33 residents. But then every time I increase my residents up top, it changes the formula on the bottom. So every month I add a new resident, this formula, the expenses change. So keep your eye on month 4, for example. It's $42,583. If I change my new resident intake to 3, that month 4 went up to 45,000 based on, hey, I have 2 more residents coming in. It's going to roughly cost me $40 per resident per day. Now that formula changes, and it changes for the next months preceding that month that I've changed. So I did the same with all of the line items. The only line item that I don't have a per resident per day is management fee, because that's a set 5%. Contract services, you'll see in senior living, they don't really label any expense item as a contract service. So I just left that line item in from the MFA tool. I really don't use it. Taxes can vary depending on market and state. And then my other income. I don't have per resident per day other income, other expenses. In this scenario, I estimated 24,000 annually would be my other miscellaneous expenses. So all this filters down to my NOI on a month-to-month basis. So this bottom line here is my NOI on a month-to-month basis. So I know what targets I'm hitting and what I'm not hitting. So I know, is my true year 1 projection really accurate, or am I going to have bumps in the road in month 3, 4, 5? If I see a gradual uptick in my NOI, then I'm happy. It's worth me to dig deeper into this underwriting, into this facility. And this is for me where it comes interesting. So this is my debt structure, same as the MFA tool. I just carry it over to the other side, but then it tells me my cash flow now on a month-to-month basis. So on the bottom line where it's highlighted red, month 1, I'm in a negative cash flow. But by month 12, I'm starting to see positive results. So that's a good sign for me. In these assets that I'm looking at, they're stabilized, but they need some TLC. So there is going to be bumps in the road for the first couple months. So me seeing that red for the first 5, 6 months, it doesn't scare me. I know the operations. I believe in the operator. I believe in the team. So I know I can carry it forward and produce results. So now all those numbers that I formulated pop up back to the actual MFA tool. Just let me black this out. All right, so all those numbers populated here. But what I did is take my T12s, I took my $40 per day per resident for payroll, my $14 per day per resident for food, and it all populated here. Now I know I can gauge, hey, their T12s had 1.2 million, my T12s has 1.4. Now I'm going to start comparing. What's payroll look like in their T12? What's payroll look like in my assumptions? What sticks out to me the most, couple line items, is the general administrative costs. My industry standard rate, it actually dropped from what they're paying. So now I have to write it down a little note. Let me dive deeper into this. Why is their G&A higher than mine? And I'm using industry standard metrics. Are they overpaying their administration? Do they have too many admins on the floor at once? Why is that number high? You'll see here another line item that sticks out to me. Their marketing right now on the T12s is $16,000. My industry standard marketing number is $66,000 that I should have for this size of facility based on the residents. That's a huge difference. That indicates to me that that's maybe why they're having problems getting residents in here. Their marketing budget sucks. So if I ramp up my marketing, my advertising, I'm expected to get more residents. So that's how I came up with that 6 new residents per year, is because I'm ramping up my marketing advertising budget. Everything else in the T12s compared to my year one looks same. Insurance is extremely high in this space. That $100,000 for a 48 bed facility is not unrealistic. It might be a tad bit higher, but 105 I'm comfortable with leaving in for now. Lastly, activities. Their activities is about half the cost as my year one. Why is that? They're probably cutting down staff. They're probably not getting the income because of their low occupancy, so they can't pay an activities director or an activities personnel. I need to ramp that up. I need the residents that are living there a sense of home, a sense of belonging, a sense of community. So activities in the senior living space is extremely, extremely important. So don't cheap out on this line item. That kind of goes hand in hand with marketing. You have to attract the residents and you have to make them happy when they're home. When families come to visit them, they want to see their loved ones doing activities, playing games, going outside. They want to see them live their normal life. Lastly, what I look at is my growth rates. So I keep my rent growth 3% year over year. I think that's really conservative. I escalate my operating expenses at a 5% year over year annualized. That basically goes in favor of expenses at a 2% ratio year over year. So that is a conservative metric that I like to use. Staffing is a huge issue in senior living, so we have to overpay some staff members to attract them. So expenses at a 5% escalation is not unrealistic. I'm starting with 19% vacancy in year one. So it's unrealistic for me to go from 19 in year one to a 5 or 10% vacancy in year two. So I'm going to trail that down. So I'm going to put a 13% vacancy in year two down to 10. And then my final year, I'm confident that I can hit a 9% vacancy. You have to be realistic with your vacancies. You can't go from a 19 to a 10 in 1 year. You're going to have residents move in, but you're also going to have residents expire. So that turnover ratio from that census report is extremely important. So what I also did to be conservative on the underwriting is my exit cap over here, I increased it year over year by 0.15. So at the end of my hold period in year 5, it's a 10.75 cap rate. In today's market, cap rates are going in a downward trend. So in 5 years, it's going to be a lot lower than 10.75, which works in my favor, which works in the LP's favor, that sales price is going to be a lot higher than what it's projecting. So based on this, I've already spoken with this broker. I have a relationship with this broker. They're okay if I submit an offer at 2.5 million. they understand the game, they understand the market that they're in. So price per bed is up top at 52,000, which in my range is a really good, attractive number to look at. I look at any facility that has a price per unit $100,000 or less. If it's over $100,000, it doesn't fit my buy box. So these are the returns that I hit based on the metrics that we just spoke about. So my minimums here, I changed. I like to see a 9% cash on cash, 22% IRR minimum, and a 2.5 equity multiple at a minimum. So if I'm not hitting these targets, I got to see why. Maybe I lower the price. Maybe I change the interest rate. Maybe I play around with a cap rate. Maybe I look at rents. Maybe rents are too low. Maybe I'm underestimating my rents. These are all factors that you have to look into. You have to understand who's your assisted living resident and who's your memory care resident. Memory care residents are a different rate than assisted living. They're typically $5,000, $6,000, $7,000 as a base rate. So you have to know the difference between AL, MC, and independent living. Give me a second. So that is the underwriting that I do. Let me just share the screen quickly. Okay, so 3 or 4 common mistakes to avoid. Don't underestimate your payroll and your staff ratios. You have to understand how many residents are coming in from that metric portion that I showed you, and you have to understand what new staff members you need for the amount of residents. It's not necessarily every new resident, I need a new staff member. There's a ratio for each facility has a different size, so it's a different ratio. Typically, there's 3 staff members on the floor for a 50-bed facility. 3 staff members around the clock, 24 hours, 7 days a week. So 3 shifts, but 3 staff members. So 9 staff members in that one day. Don't ignore deferred CapEx. All these senior living facilities that are coming on the market now, they're from distressed and tired owners. There's something wrong with a facility. It's not just they can't lease it up. There has to be a reason with something wrong with the building. Look at the roof, look at the HVAC, look at the flooring. These are huge ticket items that need to be either included or down the line ask for concessions. You can't be dishing out $150,000, $200,000 for a new roof unexpectedly. Don't overproject occupancy. I projected that 6 new residents for the year because I was confident in my operator. I had discussions with my operator. I had dialogue. I was confident in that. If I ramp that up to 10 new residents in that first year, to me, that would be over-projecting. Using the wrong exit cap rate. I briefly talked about exit cap rate. I inflate my cap rate at exit to be conservative. If I land at a higher exit dollar value, then my LPs are a lot happier, meaning they'll come back to me on my next deal. You have to account for resident turnover and that lease up time. How long is it going to take to convert that family that walks in to them actually signing a lease and getting their family's body inside the building? So these are my final takeaways, and then I'll take some questions after this. Underwriting senior living is as much as it has to do with the real estate aspect of how much my real estate will appreciate and gain in value to my operations side. I would say operations in a senior living setting is about 80% weighted. Operations is key. Without a good operator, without an experienced operator, without a knowledgeable operator, your business plan is dead in the water. There's no way that you and I can jump in and operate these facilities. We may be able to, on a multifamily side, jump in for a couple weeks in the leasing office and kind of run the show in the meantime if we're switching over management companies. But if my operator in a senior living facility leaves, I can't jump in. I know high level what to do, but I'm not in the weeds. I'm not even licensed to jump in. So your operator has to be strong. It's the most important piece of this whole puzzle. The model is only as good as the assumptions we put in. So that's why I spent weeks and weeks and months designing that little side table on the underwriting model to formulate, hey, each month, each resident, each rent increase, each expense line item, what are my targets I got to hit? Because if I only look at the end of the year, my year one, which is month 12, you saw the red line items in the first couple months. I could blow my business plan dead if I'm not paying attention to how much money I need up front. After year one, everything should be more or less stabilized. So then year 2, 3, and 4 should flow as the underwriting shows. Your financials have to align with the actual numbers you're putting in. You can't just assume the T12s are right. Their marketing was, I think, $16,000. My marketing industry standards came up to like $60,000. That's a huge difference. Why is that difference? I got to go verify that. All right. Team up with experienced partners. Get an advisor if you need to. There's advisory firms out there that would advise newer investors like us, but just partner with experienced guys like me, and I see a handful of you guys that are already in the space. It's hugely important to team up with an experienced team member. This is me, guys. Follow me on LinkedIn, Instagram. Well, I'll send out this slide deck, but you can click on the Calendly link. I got a free ebook, my Instagram tag, my contact info. I love talking about the space. I love this whole space. I spend 90% of my time focusing on senior living. I call brokers. I negotiate with brokers. I underwrite the deals. You guys mostly know, provide EMD to the deals. I love this whole sector, this whole opportunity. I'm not going to get into the weeds of the supply and demand metrics, but guys, the silver tsunami that's coming up is a huge opportunity. Lack of supply on the new development side is a huge warning sign that the opportunity is real. The economics don't lie. The supply and demand spectrum, the economics don't lie. So huge opportunity, but this also comes with a huge amount of risk.
And thank you, Roberto. There are very valuable presentation. There are quite a few questions in the chat thread, so maybe I'll go one by one. Richard, I know you raised your hand, but I want to go over the other questions before I come to you. Okay, that's good. Okay, yes, the first one is, where do you get the exit cap rate from brokers? Like, is it from brokers or it's from your own calculation?
So the exit cap rate I formulate on my own. I do my research for the entry cap rate, like the market cap rate. In this underwriting model, I use 10% to be conservative, but I want to increase the exit cap rate so as to be more conservative and be more realistic on the underwriting, kind of under promise, over deliver. A lot of underwriting models in the multifamily world, and I see in the senior living world, have a flat cap rate, or they even decrease the cap rate in year 5, which, as we know, increases the sale price. So it might be true in 5 years that will happen, but they're engineering the sale price, which in this case, that's what drives the returns. That's why we hit a 2.5x, a 3x, a 3.2x, is because of that sale price. Because we're buying it so cheap at the start at $50,000, $60,000, $70,000 a bed, we have to make sure our exit price is exactly anticipated to be that price, because the drivers come from the exit price.
Thank you, Roberto. It's very important to be conservative in your underwriting, so thanks for emphasizing multiple times. Okay, the next question, again from Cash, it's like, what is a typical lease-up time for assisted living and memory care?
So assisted living is typically easier than memory care. I've seen from my research, it takes 2 to 3 months to lease up an empty unit. If one resident moves out or expires, it typically takes 2 to 3 months to get a new resident to fill that bed. But once again, that all falls on the operators and your market team. Your marketing team is just as important as the operations. Some facilities I've seen that room stay empty for months. Like, I'm looking at this one facility for the past 8 months, their occupancy hasn't changed for 8 months. So that's poor operations in my mind.
Thank you, Roberto. Yeah, and one thing you mentioned, I just want to repeat it, is like, because this is senior living, folks expire, right? You don't get a notice when people pass on, right? So you need to have your marketing engine running all the time. So it's not like, hey, let me start the marketing after I get an empty unit. No, you need to have the marketing going all the time, so that like there's typically the industry average is like 4 to 5% of your people pass on every month. So it changes. Okay, next question. Have you customized the MFA underwriting tool specifically for senior living?
Yes, I've customized it for my way of underwriting senior living. So that toolbar that I kind of scroll to the right where I had my month-to-month view, I formulated all that. There's some formulas in the original MFA expenses and income that I formulated a little bit, I tweaked, but the main, I guess, driver is that sidebar when I scroll to the right, the month-to-month view. That's the main driver that populates back into the actual MFA original formula.
Thank you, Roberto. Next question. How's the PNL and T12 different in senior living?
Well, the layout is not different. It's just different line items. So all those line items that I had on underwriting, I'm getting from the P&L, or I'm looking for in the P&L. Senior living has food costs. It has staffing, a high ratio of staffing. Has housekeeping, which is considered turnover, but housekeeping is a 7-day-a-week operation. So it has food costs, food, staffing, and housekeeping, and activities. I think those are the main line items that are different than multifamily.
Okay, awesome. Okay, question from Sharif is like, do you have a quick underwriting model, or like do you do a full underwrite to shortlist the facilities?
That was a good question. So yes, I have a quick underwriting model. So to describe it is, I look at unit to bed ratio. So if it's 100 unit facility and it has 180 bed license, to me, there's no room for growth, meaning 80% of the units are going to be doubled up for me to get maximum occupancy. If the ratio is 100 units and licensed for 125 beds, then now my ratio is I'm a lot happier with that ratio. So based on that, then based on the whisper price, I divide the whisper price per bed, not per unit, divide the whisper price per bed, and I get a price. If that purchase price per bed falls below 100,000, or if it's close enough, like 105, 108,000, then I'm going to start diving deeper into it. My next step would be looking at the rent rolls. If I see rent is at $3,800, but the market could only sustain $4,100, it's not worth me diving deeper into it, because it's not your multifamily value add that I'm looking to increase $100, $150 a month on these residents. I'm looking for that facility that is a little bit distressed, that has $2,800 a month average rent, but down the street they're charging $4,000 or $3,800. They have nicer carpet and a fresh coat of paint, and their exterior has, I don't know, pretty palm trees and potters, which is not a high expense item for me to achieve, but facility A is not doing that. So I want to see lower rents and higher market rents. So to have that huge gap where I can increase rents $500, $600, even $1,000.
Awesome. Thank you, Roberto. All right, keep going. The next one is, okay, this is a good one. Do you usually bring a new operator or keep an existing one for your communities?
So I said before, operations are huge. So I only look in 3 markets right now. I look in Wisconsin, Georgia, and Florida. Why? Because I have relationships with operators in those 3 states. If I'm looking in Texas, for example, I can't bring these operators over to Texas. They don't have a footprint in Texas. If I build a relationship with an operator in Texas, then yeah, I'll look in Texas, I'll look in other states. But I need to have a relationship first before I start looking into that market. or I team up with one of you guys that has a relationship with an operator in Texas, and then we build the team in that way. But someone on the team has to have a stabilized relationship with the operator. Because of my size facility that I'm looking at, I look at 40 beds to about 75 beds. So those are not national brand operators. Those are not large operators that I'm looking at. That large operator, Brookdale, that operates 200 beds, he's not going to operate a 50-bed facility. So it's slim pickings for me with my operations because I can't get those statewide or nationwide operators. I got to find a localized, experienced operator in that state, in that market.
Yeah. Very good point. I would even say that unless you have an operator, you shouldn't be like even putting in offers, or like at least you should have a short list of operators before you put an offer, so that because if it did get accepted and you don't have an operator on hand, you have a very short window to actually do the due diligence. So operators actually help out with a lot of due diligence. So having the right operator helps quite a bit. Wait, hey, so we are gonna be like,
Tilak,
yes.
sorry to bother. Are we recording this call?
Yeah, it's been recorded from get-go.
Yeah, sure. Perfect. People will be asking after this call.
Okay. Yes, yeah, I'll send out the recording after this, including the slides and also the underwriting model that Roberto shared with all those things as a follow-up email. Right. I do want to go over the questions because there are quite a few. Okay. Keeping that, next was like, how do you find this industry standard numbers? Is it based on experience, or like is the report that you use?
A mix of both. I've been digging deep into senior living since last February. That's when it came across my desk, and I was shocked with the returns. So I dug very deep into this asset class. And then in turn, when I'm doing my own research and reaching out to kind of market firms, I've been getting a lot of market reports from brokers. I'm building that broker relations. So now with their OMs, some of these brokers are attaching actual 100, 200 page reports. Like they want to sell this facility. It's not for everyone, so they have to market it to specific people. So they really kind of give you everything that you ask for, everything that you need. So the sellers are paying $4,000 or $5,000 for a market study, and then we are benefiting from it because we show interest in that property. Not every broker does that, but I've have 2 brokers that send me market reports for certain properties. So all that data that I've shown you, all those numbers like $40 per resident per day, is from those reports.
Awesome, thank you. All right, moving on to the next question. Like, what are the fundamentals that you look for when choosing an operator?
They have to have experience. It can't be like owning 2 facilities. He has to have 10, 12, 15 facilities or more. He has to have a reputation, and he has to have been in the game for 10, 15 years. He can't just have 10 facilities but only start operations in the last 2 to 5 years. He has to have a track record. If his business plan is to convert from assisted living to a memory care, then he has to show me, hey, how are you going to do it? What have you done before? Where have you done it before? Show me the numbers. You have to be open with the operator, and he has to be open with you. You have to, essentially, it's like when a bank is asking a KP to sign. They're asking for your whole financial history. So the operator kind of does the same thing in a way. He opens the books, to a certain extent, to kind of advertise himself to you and to build that trust.
Awesome. Right. Next one, like, what kind of insurance is required?
Sorry, what was that? What kind of issues?
What kind of insurance?
Lots. So you need workers' comp, you need liability, you need personal, you need health, you need business, you need property, you need umbrella insurance, you need vehicle insurance because these facilities come with a vehicle. What else? I think that's it. You need a lot of insurance.
Yeah.
Not every insurance broker or every insurance provider even knows about senior living insurance. So there's only specific insurance providers that will quote you on senior living insurance. The same thing goes with lenders. There's only a handful of lenders that know this. Just like us, we're kind of new into this asset class. You'll be surprised. 80% of the lenders are new into this asset class. Historically, this asset class hasn't traded hands too often because that mom and pop that has this facility for the last 20 years, they've had a good 18 years. They've made money hand over fist for 18 years. There's no need for them to sell it. It's because of that COVID situation that we're seeing all these for sale signs. COVID hammered them. These mom and pop owners are in their 60s and 70s themselves. They don't want to go through another COVID situation. They're stabilizing the property and they're having a fire sale right now. So that's why the lenders are not even kind of caught up to this landscape.
Yeah. Yeah, just one more point on insurance, right? Insurance is very key, having the right type of insurance. And also there is this liability concept wherein like with seniors, people can fall down. There is a lot of lawsuits can come in. Different states have different litigation issues or challenges. So California and New York are like a well-known, most notorious places where like this kind of things happen, but there are other states that have similar challenges also. You need to truly have like a well-known insurance person who can actually recommend the right policy limits and things like that, because it is going to be based on where you're located, what is the challenges, what is the history of the property as well, right? Okay. I'm gonna we are 2 minutes over, but we do have quite a few questions. Roberto, can you stay a few more minutes?
I'm okay to go another hour. If you guys are okay, I'm here to educate, here to tell you guys everything I know. I'm good.
Okay. All right, sounds good. Thank you so much, Roberto. We'll spend another 15 minutes, I will, but I do want to be mindful of people's time because it's like 9 p.m. on EST already. So, okay, I'll go next. It's like, okay, next question I can myself answer. Is the lease early or monthly? It's typically monthly. There is no yearly, it's monthly basis. Okay, the next one. Is the $40 per resident per bed for payroll, does it include benefits, payroll taxes, etc.?
Yeah, it does. Great question. It does. So that's for that particular line item with all the expenses needed for that line item. Awesome. Yeah, great question.
Okay, what do you find, or like, what do you find to be the most effective marketing?
I'm gonna give away my secrets, man. Right now, I'm heavily concentrated in Central Florida. I like that Orlando, Tampa kind of area, whether it's a little bit north, south, east, west. I love Central Florida. Stay away from it, guys. I know all the markets. Talk to me if you want to get into Central Florida. I'm just joking. But I dove deep into this market. Where do the...
I think the question was about marketing, not the markets itself.
Sorry. All right. I gave away my secret. Sorry. The question is about marketing.
Yeah. What effective marketing?
Okay. So typically we hire a marketing director. So it's not the actual operator or property manager that's doing the marketing. It's an actual marketing director, or we can outsource the marketing. So we have community outreach. If we're targeting the memory care, we might connect with the Alzheimer's Society. We connect with local professional medical personnel like doctors, hospice care. We go to local like church events, go to local events like a farm event. We embed ourselves in the community because our trust and our brand recognition has to be embedded in the community. We even make relationships with our competition so that ABC down the street, we make a relationship with them because you never know their layout. If their layout is 50 residents memory care and 50 residents assisted living, if that's how the facility is set up, and all of a sudden they have a heavy wait list of memory care residents, and we can take on memory care, now we have that relationship with them, and now their overspill on memory care can get referred to us. There are agencies that you pay a referral fee that can drive residents to you. We are using it in one of our facilities, and it's really effective. Typically, it's a 1 month fee, but that resident's staying with us for life, right? 2, 3, 4, 5 years. You never know. So it's a huge relationship kind of business on the marketing side.
Okay.
Is there actually? Sorry, I was a little curious. Are those agencies are common all the states, or It's specific to state to state.
Sorry, what was the first part of the question?
The agencies which refer, who refers the
Has to
tenant.
be like kind of boots on the ground agencies. It can't be like a national brand agency. It has to be someone familiar with that area, that market, that demographic. I would not hire out of state agencies.
Yeah. I think there are two parts to that agencies, right? Then there are like national brands such as like a Place for Mom or like a caring.com, which is like Yelp for like restaurants, right? Where people go search for it. You can have contracts with them. They can send you leads your way, right? You're basically having a referral program. But as Roberto mentioned, like local agencies perform the best. There will be agencies that are, they're called placement agencies. So they place seniors in different places. And these agencies work with like hospitals or like doctors when seniors go for there, and the doctor has to recommend like, hey, you cannot go and live on your own. You have to go to assisted living or memory care. Here is a placement agency, go talk to them, right? And if you have an agreement with them, they will talk about your community a lot more than the others.
Yeah, exactly.
Right. So I know Richard has been waiting for a while. Richard, why don't you go, and then I'll follow through the next set of the questions.
Thank you very much, Roberto. Fantastic presentation. What a great value to the Warriors group. Thank you so much.
Thanks, brother. Appreciate it.
Quick question about, you come across a facility in a market you're not familiar with, you can go in and search the age demographic, right, of that particular population. But let's make up numbers. Say there's 100,000 seniors between the age of 65 and 85. Is there any kind of like statistic that says, okay, 2% of the senior population end up in memory care, or 1% or 5%? Is there just something so that you can kind of have a bird's eye view of, okay, we got 100,000 seniors, we should be getting 1,000 people a year. How many beds are in the county, right?
Yeah. So I'm trying to learn that and dive deep into that number. From my very, very early on research, I think that number sits at 4%.
Wow.
Okay. Don't quote me on that. I think it's at 4% from what I'm starting to see. Yeah. But that's
4%
that's a
will
good number to
transition.
know. Yeah. Yeah.
Okay.
But from also my research, that number should be increasing. That percentage should be increasing as the years go on, right? Because that age demographic is going to need a lot more care, and a lot more numbers are going to flush into that market. Like 4% of 1,000 is different than 4% of 100,000.
Right. No, that's right. And from 60 to 70, obviously, will be different than 70 to 80. But okay, cool, awesome, brother. Thank you.
One thing I'll add on is like, this is what typically the marketing study does for you. It's like they kind of like look at the age demographics in that area. They have these formulas, as you said, like 60 to 70, here is the percentage of people that can move. Like 70 to 80, here is the percentage. 80 to 90, here is the percentage, right? And they have a specific formula for AL, they have a specific formula for MC or like memory care. So they do these calculations and say like, okay, here is the projected supply in this area. And then they will also tie it up to the population trend and saying like, okay, here is the supply year 1, this is like year 5, right? And then you was like, okay, you have the supply, and then there is a demand aspect of, sorry, I flipped it. Here is the demand, and then the supply is like the number of communities that are coming online, right? And you try to match it up. Okay. Okay, we can move to Annabelle. You have your hand up, and we'll go back to the chat questions. Annabelle, you want to go?
Sorry, like that was accident.
Oh, okay. All right, cool. Okay, going to the chat questions back. I think what GL limits on insurance do you recommend? I can short circuit this. This truly depends on the state and the community type and the history of the community itself. So there is no easy answer here. Like your insurance person is the one who will recommend this. Yeah. All right. So next one, what is the average price of food expenses? Roberto, you covered it. I'll let you continue.
15.
Yeah, so food expenses, I start with my basis at $14 per day per resident. If I'm increasing my model by 1 resident in month 3, my food is not going to just automatically jump by $14 per day. That's the basis that I start with, is $14 per day per resident. That includes 3 meals a day, breakfast, lunch, and dinner. There's not necessarily snacks that we provide, but we leave fruit basket out for people to grab, little like nuts or granola bars, stuff like that. We leave them out on different common area tables, but the main 3 meals we provide 7 days a week.
Yeah. In my experience, I will just add like 14 is like the max. You can optimize a little bit, like it can range from anywhere from 8 to 14, depending on where you're located. Florida is a little expensive market. If you go like a Midwest, it's a little cheaper, so your expenses on food can come down a little bit, but 14 is a good number as a conservative number, I would say. Okay, keeping with the questions, okay. Do industry standard expense ratios differ from region to region, or do you use a national standard?
So expense ratios, I should have showed this in the underwriting. I tried to move fast, so I respected people's time. But expense ratios, typically industry standard is 70 to 72% expense ratio. In the underwriting models that we see, that I see, that I perform, because the property that I'm purchasing, I'm typically at a high 80s, low 90s expense ratio in year 1 and possibly in year 2. But by year 3, I have to see my expense ratio below 75% for me to be happy with that projection. If it's not below 75%, then I have to see why. It might be a error on my side, or it's going to paint a picture on that asset. Like, why is it at 75%? Maybe I'm not charging enough rent. Maybe I miscalculated my income. Maybe I miscalculated my expenses. Industry standard is typically 70% expense ratio, but you're never going to start with that in year 1 when you're buying a property that I'm targeting.
To add one more thing is like it also depends on the ratio of independent living and assisted living and memory care. Typically, memory care requires more expenses because, I mean, like it's not expenses, but memory care requires more staff to provide care. Assisted living, a little less staff. Independent living, like almost no staff, right? But so your expense ratio for independent living would be very less, but assisted living and memory care could be higher. So you got to manage that. Okay. What is the percentage of the operator? I believe the question could be like, what is the percentage we typically charge for an operator?
Anywhere between 5 to 7, I've been seeing. My operator is comfortable with 5%. I really haven't seen anything under 5%, unless it's, I haven't looked at 200 unit facilities, but what I'm looking at, nothing's under 5%. So I underwrite at 5% operation fee.
Yeah. I think 5 to 6% is the industry standard, I would say. Like, but you are right. More than 200, you can get it to 4% because they will be making like easily 200K per year on that. So okay. Yeah. One more question, and then we'll go to. And it's like, okay, would you prefer mom and pop operator over an operator who has systems and processing in place?
No, I want an operator that has systems and processes in place, but I can't get those large Brookdale operators to come operate a 50-bed facility. So that already limits me to my search. I'm only limited to, you'll be surprised, if I'm looking in Orlando, for example, and I'm looking to kind of central or the whole state of Florida, my operating bucket to choose from, there's not much out there. There's maybe 5, 6, maximum 7 operators that I can interview and talk to. Like it's important to interview these operators before you dive deep with them. But there's not a whole bucket to choose from, right? There's only a select few that kind of fit the bill. So in saying that, yes, my operators need their systems in place, right? I need to see KPIs every week or bi-weekly. I need to see an organized rent roll. I need to see an organized PL, kind of like the one I showed you. I need to see this information because to me, this is a lot more riskier than multifamily and therefore a lot more important for the GPs, the asset managers, to have their eyes on the paper. Like it's extremely important to hit these numbers and hit these targets.
Agreed. Okay. The next question. Okay, before we go to the next question, Bibi, you have your hand up. Maybe you can go.
Yes. Thank you very much, Roberto and Tilak, for this presentation. It was very informative. So I have 2 questions actually. For the operators, do they have to be local at the site? Because the way you talk about it seems like they could do it from a distance.
Yeah, so depends on the size of the operation company, but typically there's a regional director or the owner of the operations company, and then they have an executive director on site as a staff member. They're paying them whatever $85,000 a year. So that executive director is essentially responsible for that facility. So you can have, for example, if I have 5 facilities in Central Florida, I'm going to have 5 different executive directors, but 1 regional director above.
Okay. So my other question is, you mentioned the marketing budget. What's the percentage of that? Like, what percentage should you be putting aside for marketing budget?
So it's not, well, I can tell you the percentage that it comes up to be, but I go per dollar per day per resident.
Okay.
But marketing, I can look quickly. Marketing would be 8% max
of the total collected rent?
Of expenses.
8% of expenses or 8% of the revenue?
No, of expenses.
Okay, so.
But I go per dollar per day, because the percentage, it might not equal out depending on the different residents you have, especially with that line item for marketing. If I'm at 95% occupancy, I don't need a high marketing budget. If I'm at 69% occupancy and I'm taking over the property like this underwriting, the model, I need a higher marketing budget. So you'll see in my year 1, it might start at 60,000. In year 3, if I'm at 85% and my trajectory is going in the right direction, I can possibly cut that to 40, 30,000, right? So you play around with the numbers based on your business plan and based on the situation you have in front of you. So it's not like a multifamily that you have a set marketing budget year over year over year. You have to analyze senior living on a yearly basis yourself on the underwriting model, right? So staffing might go up because your residents go up, but then your marketing goes down. So that might not 100% offset each other, but that might help your NOI, right?
Okay.
Your activities might just flatline the same, whether you have 30 residents or 40 residents. A game of bingo. It doesn't matter who's playing.
Yeah.
Right. So you have to take. What I did today was condense
a
5-hour description into a 1-hour demonstration. Right.
Yeah.
And I know we have more questions, but I'm happy to talk to anyone offline in the near future and dive really deep onto this. Like I'm just trying to give you a high level, as much information as I can.
Yeah, but when you said per resident per day, is that the resident that are absent, like the empty beds per day, or the total resident?
No, if my license shows 40 residents, but I only have 30, that per resident per day cost is based on 30. Based on my occupancy, not my license.
Not the rest. Okay.
Yeah, it's like bodies I have in the facility.
Okay.
Yeah. I'll just add one more thing on the marketing, and I want to make sure like we address the questions. We are already 20 minutes over. So marketing also, the amount of money you're spending, it's also the strategy you use, right? If you use placement agencies or referral agencies, they charge you a month, right? That's like, it could be like 3 or 4K per residence that got moved in, right? That could be expensive versus like, you could spend like Facebook ads, Google ads for like $1,000, $2,000, right? So it changes dramatically. And one strategy would be useful when you're trying to increase occupancy versus like trying to acquire a fill from 85 to 95. So different strategies needs to be applied at different stages of occupancy.
Okay. Well, thank you.
Thank you.
All right. So I'll say like 3 more questions and we'll wrap it up. So next one is like, do you offer shareholding to the operator, and if so, what percentage? And does this reduce the management fee?
That was a good question. That was my little secret. So it's asset dependent, but the last couple of deals that I've closed, I've offered a small GP percentage to the operator. Reason being is I want them to have skin in the game. I'm okay with giving up 3, 4, 5% of the GP, especially at those ratios, like a 50-50 split. I'm okay with giving up 5% because now the operator has incentive to work. If I don't give him skin in the game, he just operates a facility. Okay, I hit one new resident. Okay, you told me to hit 2 new residents. Oops, I only hit 1. He still gets paid his 5%. He doesn't care. Now that he has skin in the game and I've educated and showed him the syndication model and the underwriting, he sees those returns. He's going to work his butt off to get 3 or 4 residents instead of 1 because he sees those returns. So yes, I give away GP percentage to operators.
One other strategy I have employed also is like, if you can also give equity percentage, or like you can have percentage of the fee based on the profit, not just on the revenue, right? So you can split the fee and in 2 parts, like one on the revenue and one on the profit, so that they are incentivized not just to increase the revenue, but also decrease the expenses and increase the profit. So that also helps. Okay. Okay. Next one, I think I missed a question from Erin earlier. Is like, why is the caregiver turnover ratio such a issue, and what can be done to improve it?
So before COVID, there was really no issues with staffing. People woke up, they loved their job, they did what they had to do. They got paid. Honestly, they get paid very low for what they do. They do not get a good paycheck. They do it more for passion. Before COVID, everything was fine with staffing. COVID rocked the whole industry. A lot of staff members just gave up on the industry and left the industry as a whole. They went somewhere else to a different industry. So our staffing issues that we see post-COVID, 2-3 years after COVID, is higher turnovers because less qualified people. We have to entice them with $1 or $2 more per hour to get them in, but we're seeing, from my experience, we can't retain them. The reason why? Because they haven't themselves been in the industry a long time. They're just maybe testing it out. Maybe they have 4 or 5 years experience, and they don't have it in their heart, and it's not their passion to give care. What I have seen in the last couple of months is the staff members that have left during COVID are now coming back. So that's a good sign for staffing. I think staffing issues will correct itself in about 3 years, but for the next couple of years, it's going to be bumpy and high turnover. But I think in 3 years, you're going to have those passionate staff members come back.
Yeah, I'll just add one more thing. Also, the industry realizes this issue. And there are like more training programs that are being put together. There are companies spinning up to train these people, and people are also seeing as an opportunity to get like a stable living, right? Because this opportunity or like this situation is not going to get better or shrink. Okay, I think we are at last question. Are residents eligible to receive any form of government assistance? If so, do you anticipate any risk of this funding being reduced or cut?
Yeah, so Medicaid is funded by the government. Each state has a different cap. Like for example, in Georgia, I think it's $67 per day per resident. So there's a cap on that. I didn't get into the weeds of it because on the length of the presentation, but when you have 40 units and 60 beds, meaning you have some rooms doubled up, that's where I, as an investor, want to see the doubled up rooms be only memory care residents. So if my standard single private room is getting $4,200, but my doubled up Medicaid resident is getting $2,500 each, that totals $5,000. So that could be a huge revenue generator if you have a doubled up Medicaid resident in that room generating $5,000 a room, as opposed to that single private pay generating $4,200. So that's part of the business plan, business strategy. Like I said, I did get in the weeds on it. I wanted to simplify it, but on that model that I have, it takes that in consideration also. I don't see it getting cut. All this noise that you hear from Medicaid cuts, if you read the fine print, it doesn't affect the senior living sector, like the care sector.
I think, all right, one last question. Like, are there any recommended reading books, articles, studies, for example?
So it's free and there's a paid version. The paid version, you obviously get a lot more material and you'll become a professional. But Nick Map Vision, strangest name ever, Nick Map Vision is leading a senior living data research market firm company in North America. I'm not sure about the world, but they're huge. Nick Map Vision, just search them up. They have a cool website. They have free blogs, and you can see free data on those blogs and charts. You could pay for a subscription if you want to get actual market reports, but it's a great tool to have on the free version.
Yeah, I'll just add that NICMAP is, or like NICMAP also conducts like I think for 3 conferences a yearly. It's a great place to be. It's like if you are truly serious about senior living, all the big players come there. It is expensive. I think the last one I attended was in March, and it was like $2,000 entry fee, right? But that also means like people who are serious will be there, right? It's not like people who are just wanting to explore, right? And that's a great way to meet operators, great way to meet lenders. Everybody would be there, so you have like a good network. There is one upcoming in September that is in Austin, right? So Fall Conference is one of the big ones. So if you're thinking about it, that's a good place to kind of like book and come in. Okay, I think that's it on the questions. Thank you so much, Roberto, for taking almost additional 30 minutes. Thank you everyone for staying and attending this session. I just want to close saying like this, we are trying to do this on a monthly basis. We kind of like didn't do for the last couple of months or like 1 month. But if you have any topics, feel free to message me. Happy to include the topics in the future things. And I also added a link in the chat thread for people to sign up. And I'll work with Roberto to get the materials that was shared to everyone and the recording as well. Okay. Thank you, everyone.
Thank you, everyone. Appreciate you all. Thank you.
Thank you.
Thanks, guys. Thanks, Roberto. Thanks, Elak.
Thanks, Darren.
Thank you. Thank you.
Get that picture, Roberto.
Yo, Instagram, man, it's going
Yo,
live.
what's up?
It's going live. I got Ron. Let's just stay here and chat, guys. Ronald, you getting to senior living now?
This is my first time. I don't know.
Yeah, your first time's always your best time. You'll always remember the first, buddy.
Don't get me in trouble. It's me people here.
I know. There's a recording. Say, who else is here, man? Cash. I only see like 6 people.
Hi, Roberto. Good evening. How are you?
Good. Who's that?
My name is Philip.
Hey, Philip, how are you?
I'm doing great. I'm from New York. I got sent an invite from Mary Lou.
Okay, awesome.
Yes.
I appreciate
great
it.
presentation. So my buddy of mine, we were both in the meeting, but we dispo and majorly like wholesale. So not sure if there's a way we can also connect with you. But it was really
Absolutely.
nice. Yes.
Yeah.
So
No, that's what it's all about, right? Connections and working together and partnering.
yes, sir.
Yeah, do you see that? Did you
Yes.
grab this from the start?
1 second.
Yeah.
Yeah, I came in a little bit. Oh, okay. Let me screenshot that.
Let me get that.
Yeah, are we still recording?
Of course.
Awesome.
And no, I love helping. I like talking about it. I like educating. So any
Okay.
questions you have, we can talk.
Okay. Thank you so much.
No problem.
Quick
And
one.
hello to everybody.
Hey, bud.
Yes, this is Philip from New York.
Roberto,
Sorry, I don't have my video on. I have my baby with my aunt, so I don't want to. Well, thank you so much. Just wanted
All
to
right.
get to introduce myself. Thanks.
Awesome. Thank you.
Yes, sir.
All right, guys, I'm going to jump off then if there's nothing else.
Hey, Roberto, quick question for you.
Yeah. Sorry, Cash, you seem far away. I can't hear you too well.
Oh, 1 sec. Can you hear me now?
Yeah, better.
Did you say you increase it by census, right?
Sorry, bud, you seem far away
Gosh,
again.
you're still far.
Okay.
Yes.
So the rates you the PRD, the food for the food, increase per census, right? So every month as you have census increasing, you're just increasing those or multiplying it, right? So 14 times whatever your census is.
Exactly. So that I'm gonna try to share my screen, but that amount, the new resident number I put on the top. Hold on, I'll show you. Here. So every time I put a new resident amount on the top here, it changes everything. It changes my income. It adds a community fee on other income. You see how some line items have different numbers. So every one equals 2,500 community fee, but then also auto-populates this, whatever, month 6 expenses based on this dollar amount per resident per day on the right side here that I put.
Perfect.
So
Yep.
every census I input, 1, 2, 3, whatever number I put, it multiplies it by $40 per day. So essentially, if you look at the bottom, the total comes up to 97. So a high level quick underwriting, if you take $100 per resident per day, you'll get your expenses that you should be targeting. So if your number comes up to 2 million, but then the T12s are showing 1 million, you know there's either missing information, they're not sending you the correct information, or there's a huge disconnect because you know you have to be in that 2 million range, for example, right? So in the quick underwriting model, that's one metric that I use is $100 per day per resident.
Got it. And how do you, so conversion from AL to MC, how do you factor that in that model?
Come on, man.
All right, we'll talk after. How's that?
It's hard. Because I'm not a spreadsheet, like I like spreadsheet, but those formulas took a long time for me. I can't get, I don't know the equation, the long equation to get L or MC residents. So, but I know the difference. So for every AL resident, for every MC resident that I anticipate, I put the number 2 for like AL. You follow me?
Oh, that's
like
how you
AL
convert
is
it?
equal 1 resident essentially.
Yeah. Okay.
Just for a high level underwriting, because I don't know how to do that long formula.
Yeah, no, because I'm building something like that, but that's why I wanted to know the logic you use. That's all.
Yeah, I'm happy to share screen. Like another day, you and I share screen. And
Yeah,
have
we'll work on it.
Oh,
I just
well.
want to know what the expertise or the logic behind is, because then
Yeah,
it makes sense to have it done separately.
because people, when they hear AL and MC, they think, oh, automatically when you convert to memory care, your staff goes up, your food goes up, your costs go up. Honestly, it doesn't. It might go up like less than 4 or 5% because your staffing ratio doesn't change. In the state of Florida, state of Georgia, Wisconsin, your staffing ratio doesn't change. Your food, honestly, it doesn't change. I would argue that the memory care eats less than assisted living, but your food doesn't change.
It's
Your
really
activity,
level of care, right? So
well, I would argue your activities decrease because that memory care Alzheimer's guy is not playing bingo. So like there's a lot of expenses that decrease when you have memory care, but your revenue, you're charging $6,000-7,000 a month for that memory care. Yeah, they need additional level of care, but that falls on your staff to provide it. You don't need a magical extra staff member. If you're generating a lot of high income, you can hire another staff member to complement that service and be that good operator, that good facility. But legally, you don't have to.
yep, makes sense. Thank you.
Yeah.
Hey, Roberto.
What's
Two
up?
quick,
Let's
yeah,
see.
yeah, it's 2 quick questions. So I saw that you have like a customized underwriting sheet. Is there a way that, is that shareable, or do you have a course that you teach, that to help us build our own?
Not yet, brother. I'm working on some coaching programs, maybe. Not coaching, but like mentorship programs. What do you want to call it? But I'm happy to share whatever I have. Everything's for free. I'm not charging nothing.
Okay.
Yeah.
And
yeah.
Okay, so
I have your contact. I'll send it to you.
all right, perfect. Thank you.
Yeah.
And And how do you suggest connecting with brokers in this space? Because I feel like you're not reaching out to the same kind of brokers, right? So how do you come across them?
So I started a year ago looking on LoopNet and Crexy and even just doing like a simple internet search. Through that momentum, I started, they've actually put me in contact with actual senior living brokers. So that timeline has built up my deal flow. Like I get maybe 2 to 3 deals a week from different brokers. 90% are all garbage, but the deal flow is real if you're connected with a handful of good brokers.
Okay.
Yeah.
Okay. Yeah. No, that's good because usually when you think of LoopNet or Crexy, it's like, oh, it's oversaturated, but it's about the next layer, I guess.
So yeah, I don't
Okay.
use those platforms to find deals. I scope out brokers, like who has those listings. So even if I call a broker and he's not in my market, he'll know someone that knows someone, type of thing.
Got
Right?
it.
I'm just using that for my initial kind of reach out.
Okay. No, that's great information. Thank you.
Yeah. That's it. All right, guys, I'm going to hop off if everyone's cool. Let me know if you have another question.
Thanks a lot, Roberto.